Good morning and welcome to this Wednesday, January 13th, 2021 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we had, a little bit of mixed action on Tuesday, and we are getting closer and closer to the end of this historically bullish period. We do have options expiring in just a couple of days. Futures this morning are down a bit. Got the Dow Jones currently down 46, the S&P about 8, and the NASDAQ around 29. So it looks like we'll start off a little bit on the negative side. Earnings season right around the corner. Friday morning kicks off many of the big money center banks. Excuse me, the JP Morgans, and Citigroup's, Bank of America's of the world. Those companies will be coming out on Friday. And with the 10-year Treasury yield beginning to move higher, I don't know what the earnings will be, but I have a feeling that the guidance is going to be upbeat. I expect that these companies are going to start to say, hey, we can see the light at the end of the tunnel. It'll be very interesting with the vaccine news out, whether or not the banks talk at all. Well, I'm sure they will talk some, but I'm wondering if they're going to adjust maybe their loan loss reserves going forward, being a little bit more optimistic, again, with the vaccine news that's come out over the past couple of months. So we've got that to look forward to. But overall, I mean, the market still has remained pretty strong. And as I pointed out at the end of October, that period, October 27th at the close through the close on January 18th, that is historically the best period to be in U.S. equities, and specifically the S&P 500. That comes to an end. Today's the 13th, so technically it's 5 days from now, which would be Monday of next week, would be the end of that bullish period. Now, that doesn't mean that we're going to see a major sell-off. It's just we're moving out of that historical period, and it's something we probably should be aware of in the event that we do see some consolidation, some basing. It would be kind of the historical norm. So just keep that in mind. All right, let's move over to the Earnings Beats page. For those of you who are not members or are not subscribers to our free newsletter, I'd certainly encourage you to at least take out that free Earnings Beats Digest newsletter. I publish that Mondays, Wednesdays, and Friday mornings. Today kind of went a different direction, but talked a little bit about, things that would tell me maybe to sell. Some of the things I look for in terms of selling as a trader, not as a buy and holder or an investor, but a trader. So where you're trying to capture the short-term moves to the upside, and then maybe buy on pullbacks and so forth. Talked a little bit about that in today's Earnings Beats Digest, but just type in your name, email address, hit that subscribe button. We'll make sure we get you on the list, and you can become part of our big community. We literally have thousands and thousands of folks who are on our free newsletter. We'd love to have you join us and, kind of work through this market together. Now, if you're a member, and we have been getting a ton of email and testimonials, and thank you, keep them coming. But our portfolios, I mean, if you look at the numbers, it's been crazy. The strong AD portfolio now is up just since May 19th, 95%. And it's been a good market. I mean, the S&P 500 since that date, since May 19th, 2020, the S&P 500 is up 30%. So it's been a nice run to the upside, no question. But 95%, that's more than triple the S&P 500, almost 100% in less than 8 months. It's pretty crazy. This quarter, look at all of our portfolios really doing extremely well versus the benchmark S&P for the current quarter. And we talk about current quarter, by the way. We're not talking about January 1st to March 31st. We're not talking about the current calendar quarter. We're talking about an earnings beats quarter. We announce our portfolios on February 19th, May 19th, August 19th, and November 19th. So this quarter has been since November 19th. So this quarter on our portfolios, you can see in this column, and this is what the S&P's done. It's been pretty crazy. And like I said, we've gotten a lot of really positive feedback from our members. Keep it coming. We'd love to hear more. We're actually going to be putting a testimonial page on our site. So we'd love to have you write in if you're a member. And make sure when you do write in, whatever testimonial you give, it would really help us if you say, I consent to your use of the testimonial on your website. And what we're looking to do is also put your first name, last initial, along with your wherever you live. So if you're okay with all of that, it would be great if in your testimonial you let us know. And you can send those into, I think we have a testimonial. I don't know, Abby, if you're there, if you can, do we have a testimonial at Earnings Beats or testimonials at Earnings Beats email? I may have caught her by surprise, but I'll definitely get that out to everybody. I don't know if we have one. I know we talked about it, and I think we had set one up, but we haven't really promoted it. But worst case, you can always send it into support@earningsbeats.com. We'd love to hear from you, and let us know, what Earnings Beats has done to help you. All right, let's move on. Take a look at what happened on Tuesday. Today's Wednesday. On Tuesday, we saw the Dow Jones Industrial Average up 60. S&P was relatively flat, up 1.5 points. The NASDAQ did a little bit better, up 36. But once again, the strength, and I'm going to talk about this in just a couple minutes, but the relative strength again, mid caps, small caps. I mean, this is helping to power some of our portfolios to the upside, because seeing that relative strength building these past few months actually encouraged us to put more smaller and mid cap stocks into our portfolios, and that certainly has helped us as well. Energy, discretionary, materials, those three groups led the action on Tuesday. Energy, nice breakout there. That's really strong. Crude oil prices, last time I looked, $53 a barrel. Let's see what they're doing this morning. Yeah, $53.60. They're up another 38 cents this morning. So $53.60. The thing you have to understand about crude oil prices is they go up when we get global demand. And we've talked about how we're in a global secular bull market. And so that's definitely lifting energy. I expect, in a secular bull market, I expect every group to go higher. So even when I talk, and occasionally I talk about energy materials and how I'm not huge fans going forward, because I do think the dollar is going to rebound. It doesn't mean that I don't like the stocks going higher. I just don't like them on a relative basis. If we're trying to outperform the S&P 500, the key is to zero in on the areas that are outperforming the S&P 500. So I think energy and materials is going to go up. There's a lot of pent-up demand. We're seeing a lot of that movement to the upside in the near term. I just don't know that these are going to be, the energy and materials I'm talking about. I don't know that they're going to be the leaders in 2021. Now, if I'm wrong about the dollar, then I'm likely wrong about energy and materials. So it's going to come down to what happens in the dollar. I just believe the dollar is going to rebound again in 2021. All right, discretionary also having a pretty good day there. You can see really making this big move up here to start 2021. Later this month, I'll be talking more about the January effect. And if you haven't heard about the January effect, the stock market really historically seems to take a cue from January performance. So when January is strong, normally the balance of the year is very strong. So shouldn't be too upset by what we're seeing in January so far. But again, we'll talk about that later in the month. Communication services down 1.6%. So again, the sideways consolidation, we pulled back. This is a pretty key area of support right around 65. So I wouldn't be surprised to see maybe communication services begin to show a little relative strength. Healthcare made the big breakout, but it did pull back, was down a little over 1% on Tuesday. So we saw a little bit of lagging in that area. All right, let's move on to the 10-year Treasury yield. Now, as far as economic reports go, we did have the December CPI released this morning, and it showed that consumer price index had risen 0.4%. That was exactly what was expected. And the December core CPI rose 0.1%, which was exactly what was expected. So not a whole lot going on there in terms of a surprise. Later today, we're going to get the Beige Book. That'll be released at 2 p.m. If you're not familiar with the Beige Book, it's produced, I think it's 2 weeks before the Fed meeting. Well, actually, I know it's 2 weeks before the Fed meeting. And essentially, one of the Fed districts will compile economic data from around the country, all around all the Fed districts. And so it gives you a little bit of insight as to what the Fed may be thinking and what they may be doing in their upcoming Fed meeting. Now, I'm not looking for any action in terms of interest rates being hiked, but it's always good to keep an eye on what the Fed is thinking, because they can help or hurt the market in a lot of other ways besides just raising or lowering interest rates. So the market usually cues in on that beige book. And again, that'll be out at 2 o'clock this afternoon. All right, 10-year Treasury yield, when I look at it, I think we're topping here in the near term. I don't like that candle. We were moving straight up, put in a bearish black filled candle off of an uptrend where you're seeing the yield going up from open to close throughout the day. That reversed yesterday. And we opened a filled candle. Anytime you have a filled candle, you're below the open. You close below the open. Or if it's intraday, your current price is below the open. So for instance, right now, we opened 1.13, and now we're at 1.12. So that's why we have a red filled candle. And the reason it's red versus black is we're actually down 2 basis points. That's why it's red. Yesterday, the yield was actually up for the day. So that's why it's filled black, but it's still closed below the open. Candlesticks are pretty cool to use visually. I've been using them for so long that I take it for granted now. It's like a language that I can just read the chart based on a lot of the candles. And that's the way you'll get if you continue to study and watch candlesticks. Many of you probably already do. But yeah, when I start seeing that, I think, okay, we're probably topping near term. So what does that mean? Before I look at anything else, that means probably the run we've seen on financials may halt for a period of time. We might see a little bit of profit taking. And some of them have gone up so much, especially some of the big money center banks that'll be reporting earnings on Wednesday. I wouldn't be surprised to see maybe a couple, some folks moving to the sidelines before those reports come out. And this is what the 10-year Treasury is telling me as well. All right, let's move on. I want to talk technically. Let's do a little talking technically. So I mentioned the small caps and mid caps have been doing really well. And when we picked our last portfolio, we had been flying in small caps. Remember, November 9th is when we had the vaccine news. Many small companies rely on their credit line. They're not Apple. They don't have, billions and billions and billions of cash sitting in their, coffers. Most small companies rely on a lifeline from a financial institution. Same with mid caps. And so a lot of these companies, small caps, were hit particularly hard with the virus. And that's why banks were hit so hard, because, the Apples of the world didn't need the banks. I mean, that's not where banks make their money. They make their money from folks who need to borrow. And the ones that needed to borrow were the ones that were being hit the hardest by the virus. So it was just kind of a snowball effect. Well, when the virus news came out, I think you can kind of see what happened here. If you can't, let me just explain it, because this is really important, especially for the balance of 2021 going forward. But, we had this lower highs and higher lows. So we were squeezing in this triangle, but it was off of a downtrend. That's a symmetrical triangle off of a downtrend. It's all relative, by the way. This is a relative chart. But I would have favored probably a breakdown off of this triangle. And instead, we got a breakout. And the breakout occurred exactly on November 9th, when the vaccine news, the first positive vaccine news came out from Pfizer. And the next week, when we got the next news from Moderna, you can see we broke out again. So that has set the stage for small caps. And so when we did our portfolios on November 19th, which was right in here, that was coming on the heels of this breakout. And so, we don't have a small cap portfolio, but we do have an aggressive portfolio, and we focused more in the aggressive portfolio on some of the small cap stocks. But anyhow, this has been a huge run in the small caps relative to the S&P 500. That's what this chart is telling us. Not whether small caps are going up or going down. You could have an uptrend in a relative chart and have a downtrend on an absolute chart. It would just mean that the small caps move to the downside was better than the S&P's move to the downside. So understand what a relative chart is going to tell you, this ratio. It's just telling you how small caps are doing relative to the large cap benchmark S&P 500. And I think it's pretty clear what they're doing. They're going straight up. This is where money is rotating heavily to, and has been for the last 3.5 months. So it's really important to understand what's taking place in the market, where things are going, and then begin to look for your trades based on where the money's going. You're going to have a much better opportunity to make money if you're trading in areas. If you're on the long side and you're trading in areas that are outperforming, you're going to see your results move. It's going to become much better, is what I'm trying to say. Anyhow, that's the small caps. Look at mid caps. I mean, we got the same thing. Mid caps made the breakout here to about a 4-month high right on November 9th. And then by the time the end of November had rolled around, you can see we were already breaking above that relative high in June, and we've continued. And when we've pulled back on a relative basis, notice that rising relative 20-day EMA has been holding as support. So we get a little bit of weakness, and that becomes an opportunity to buy into that area, just like we see with individual stocks when they pull back to rising 20 days. It's really important to kind of watch these trends take place. So mid caps and small caps continue to be really fertile ground for excellent trading opportunities. All right, I'm going to move into some scanning, and this is going to be more predefined scanning. We talked a little bit about candlesticks, and I don't know if you know it, but if you go down here to your scans, and right here where it says more, if you click on that, you can click on the predefined scans. Now, let me back up because if you're going down your dashboard page and you don't see your scans, the first thing you need to do is go over and hit this gear shift. See how I've got scans and alerts checked off? If I don't have that checked off, it's gone. It's not there. So that's the first thing you've got to make sure is that you have your scans and alerts checked off. And then with that, you can go into the more area here, click on predefined scans. This is an area of the website that if you're not familiar with, I think you could probably get a lot of really good use out of. You can see new 52-week highs right at the top. So if you're wondering what's working in the market, pretty easy. New 52-week highs, click on NASDAQ. That'll give you the 307 NASDAQ stocks that just hit a 52-week high. You can then download these right into a chart list if you want and start running scans against these, or sorting them however you want. In this form, you can sort by scooter if you want. So there's your highest scooters. They've probably been going up quite a bit. I can tell you Celsius Holdings right here. This one's in one of our portfolios, has been absolutely a monster. Let me pull up that chart and show you. I mean, if you want to know why our portfolios are strong, it's because of stocks like Celsius Holdings. And prior to I really didn't know this company that well, but look at the reaction to its last earnings right before we announced our portfolios. It was a huge move up. We gapped up. Not only did we gap up, then we kept going up, meaning usually gap up market makers on the other side of the trade because everybody wants in on the long side. So usually what you see is a gap fill. Market makers are shorting. If market makers are shorting at the open, normally we're going to move back down. And you can see early in the day we had a little tail that came back down close to gap support. And then we exploded to the upside. And look at the volume. It's really hard to misunderstand volume that's that heavy when you're going higher. That's screaming to me of accumulation. And if that's not screaming, then the AD line should be. And as we've moved up, AD line continues to move up, set new highs. Great volume trends. This stock on November 19th was probably around 30, right around 35, 34, 35. It's at 59 now. So $25 on a $34 stock. That'll help lift the portfolio. But anyway, so that's CELH. That's just going off of this list. But another feature that's really cool, if you haven't seen this, is you can see what the scan is, the scan syntax. When you go to write your scans, it's important to begin to understand the language that Stock Charts uses in the scan engine. And so if you want to know, how do you write a scan looking for 52-week highs on the NASDAQ? Well, click on that. It'll give you the edit scan. This is how you write it. So if you're looking for, a 20-day high, you could start with this and say, give me the daily highs greater than yesterday daily high. And instead of 253 days, and if you're wondering why that's 253 instead of 365, 253 is trading days. So the scan engine thinks in terms of trading days. All right. So 253, but let's say you wanted to make it 20-day. Give me the stocks that are hitting 20-day high. Let's get rid of the OTCBB because I'm not a fan there. I don't really want those stocks. And then give me the volume, let's say 300,000. I mean, do you see how you can kind of take a scan that Stock Charts has already done, and then you can manipulate it? And then if you really like it after you're done, maybe you want to add the scooter. So let's say, scooter, add scooter greater than 90. Or maybe you want to see a stock that's moving to a new 20-day high where the scooter is less than 90. So it's not one of, so it's not one of the really, it's not one of the real strong stocks, it's been going up day after day. If the scooter's under 90, then it's not on a relative basis in that top 10%. So maybe we're just catching a breakout where there's been a little bit more consolidation. Now, I don't know if this is going to yield anything. Let's go ahead and check syntax first. So look at that. I'm a scanning genius. And all I did is I started with what Stock Charts gave me and just adjusted a few things. All right, now I don't know if anything's going to come out on this or not, but let's just check it out. Well, yeah, 193. So quite a few. Let me go back here. And let's say a scooter is less than 80. Now we're down to 142. Now remember, we're doing 20-day highs. So we could have really bad stocks in here that are just seeing a slight movement to the upside. It just happens to be the best level it's been in 20 days. So what you might do is go back in here and say, okay, also let's do the scooter. Let's get rid of all those really bad stocks. And let's do the scooter, add, and let's make sure that the scooter is at least 60 or maybe even 70. This will give us all the scooters between 70 and 80. All right, check syntax. We're still a genius. And now we run the scan. And now we have 41 stocks. 41 stocks between 70 and 80 are setting a 20-day high. That's how easy it is to use Stock Charts. Let them, they've done all the work in terms of the scan syntax. So you can just kind of manipulate it. And that'll help you learn how to write some of these and write your own scans if you don't already. And when I've done these scans, when I did, at Earnings Beats, we have, I think, five or six predefined scans that we already have the scan syntax on our website. So members can take that and then run their own scans against our chart list or run them against the entire Stock Charts population if you want. But when I first did that, I had a lot of members writing in saying I never knew how to use the Stock Chart scan engine. So hopefully this is helping you. Maybe there's someone out there that all of a sudden now a light bulb just went off and maybe you'll be able to use the scan engine much better. But again, my point, going back to the, let's go all the way back to the technical indicators and the predefined scans. My point here is that you could pull up any of these strong volume gainers. You pull that up and click here. How does Stock Charts look for stocks that have higher volume? What are the parameters? Do I want to change those parameters? All of this is right at your fingertips. Just got to know where to find it. But I want to go down here and take a look at the candlestick patterns because I mentioned the 10-year Treasury yield and the fact that it put in that black filled candle. And if you go down under single candle patterns, filled black candles is one that Stock Charts will give you. So if you want a filled black candle on the NASDAQ, click on that. It'll give you the 167. Now, what you might do is you might look and say, give me the highest rated stocks. And maybe, I don't know if you're somebody who wants to short or maybe wants to do something with options expiring this week. but you might take a look at some of these that have really made big runs to the upside. And if they're printing a black filled candle, it might be a sign of a possible reversal. Now that one to me is that's not coming after a big move up. It's not a big filled candle body. It doesn't have heavy volume. Those are all the things that I would be looking for. So let's go back and let's see if we'll just look at a few of these and see if we can find one. Same thing there. It's a black filled candle. Look at this one though. Look at this one. You see how you got the big moves up, big black candle, and then that's the high for a while. Same thing here, that big black candle, and you see how you pull back for a while? That's what you want to look for. And look at the volume. See the volume surge on these? Look at this volume surge. It's telling you it's an exhaustive kind of move to the upside. Now, does that guarantee we're going to go lower after that prints? No. And in fact, look, the next couple of days after we went down here, we went back to the upside. Same here. After that couple of days, we went to the upside, and then we ended up falling back. But it's just telling you that the market or that particular stock maybe is a little bit toppy. And I think that's the real key to take from that. Maybe look at a couple more, see if there's anything else. See, now there's one a few days ago that I would be a little cautious of. That's one for sure that I would be a little wary of. Okay, let's move on. And I want to just talk quickly about relative strength, because we do have our model ETF portfolio draft coming up on Tuesday of next week, January 19th. And even though we don't show that, we're going to be showing that soon. The problem is it was kind of weird when we had it on here because this quarter is different because we run different quarters on the ETF. So we started off putting it in here, and then it's just been kind of weird. But we're up as of last Friday. I haven't updated it for the last 2 days, but I think we did well the last 2 days as well. But as of last Friday, we were 4 percentage points above the S&P 500 with our model ETF portfolio. And we're only talking about over the last 2 months and 3 weeks, 2 months, 4 weeks, whatever. So my point is, when we look at these relative strength charts, just like I showed you with small caps and mid caps are doing really well. There's a good chance you're going to see a small cap or a mid cap in our model ETF portfolio come next Tuesday. I also look at the sectors because I want to see which sectors I want to move toward. Where do we want to put our money? What sectors do we want to have our money invested in? Do we want money in technology? I would say yes. This is the relative chart of technology relative to the S&P. Now, we've been consolidating, but we're still in an uptrend. And if anything, this relative PPO getting closer and closer to the center line tells me we might be ready to launch again to the upside. So yeah, technology is definitely an area that we're going to want to be concentrated in. How about consumer discretionary? We're breaking out again to another all-time high versus the S&P 500. I mean, look at the chart. Why would you not want to be in consumer discretionary? Now, I'm just going to fast forward. Let me just show you what energy is doing. Energy is showing strength, but do you see the difference? If I go back on energy 10 years, this is about the length of time that the dollar has been in a long-term uptrend. And look, and the dollar bottomed in 2011, and the relative strength of energy topped in 2011. And we've been going down. I'm not so sure this isn't just a little dead cat bounce. Getting back up above the 50 days nice, or 50-week SMA is nice right here. But we've done that before. I don't think we can definitively say that this downtrend has ended. And if the dollar rebounds like I think it's going to, I think energy is going to continue to underperform, even though we might continue to see it go higher. The XLE might go up to 50, 55, but it might still be underperforming the S&P 500. And that, again, is where we're going to focus. So just wanted to point that out with relative strength with the model ETF draft day coming up next Tuesday. If you want to be in on that, by the way, you can take out a free trial. We have a 30-day trial. It's actually, you pay $7, but we refund you the $7 within a week. So for 30 days, there's no cost. And you can check us out and see if what you think of the model ETF draft. You get an idea of exactly what we think about the market. It would be a great time. So if you go over to Earnings Beats, just click on this Join Today button, and and then you can get set up. Otherwise, this is the free newsletter. over here that I talked about earlier. Earnings Beats Digest, no credit card required. You can unsubscribe at any time. Not going to hurt my feelings. But this is a really good educational piece that I think everyone will enjoy. All right, let's wrap this thing up with the 3 you must see. I'm going to start with Occidental Petroleum. The reason I'm going to start with this, last night in the Max Payne webinar, I forgot to bring this up, but last month, Occidental Petroleum, as we went into option expiration week, had signs that, it was breaking out. It looked really good, but there were a ton of in-the-money calls on Occidental Petroleum. A lot of folks on the call side. And so what we said in Max Payne session last month was you want to be careful, because a stock that there's a lot of financial incentive for market makers to potentially take a stock down when there's a lot of net in the money call premium on the table heading into option expiration Friday. And look at what this stock did. Now, the other thing I tell folks is that it's a short-term phenomenon. It's not get out of Occidental Petroleum because it's going to go into a bear market because December options are tilting toward the call side. That has nothing to do with it. It's not a long-term call. It's a short-term call, and you can see what happened. We did actually move back down. Now look what's happening. Occidental Petroleum comes right back, and now yesterday broke to a new high since June. So do you see how that short-term Max Payne influenced or likely influenced the short-term direction, but then the long-term comes right back miraculously? That is why we do what we do with Max Payne. So as a trader, if you're looking at buying Occidental Petroleum, you don't do it the week of options expiration when the options world is beating you over the head not to buy the stock, because of there's so many in the money calls on the table for market makers to possibly wipe out. I'm not saying that, there was no guarantee it was going to go lower. I just said there was a lot of risk at the time, and it did end up going lower. Now it's come roaring back. So I wanted to point that one out as one that you needed to see. Next up, let's take a look at Etsy. This is one of our portfolio stocks, and the stock moved up really nicely, pulled back. You see the prior high right here, about 165? That's right where we pulled back to, just below the 20-day, right to price support, and we turned right back up. Look at the AD line, breaking back to a new high with yesterday's surge. Look at the volume behind the move to the upside. And then look at the relative strength. Etsy continues to be a very strong stock. And if this continues into February, when we do our draft for our stock portfolios on February 19th, Etsy's probably going to find itself in our portfolios again. We don't give up on stocks just because they've gone higher. We take advantage of that. They're leaders. And the last one I'll show you, just to kind of drive home this point, is Tesla. I mean, if we had gotten out of Tesla every time that the stock was overbought or that we thought it had just run too much, it's gone up too much. It just can't go up any higher, right? This is when they got added to the S&P 500. The stock was at 450. It has doubled since then. I mean, that was already tremendous growth up to 450. But after breaking out, after being added to the S&P 500, now look at Tesla up near 900. Now, are you going to sit back and say, well, yeah, but it can't go any higher? Well, if that's, everyone can make their calls. But what I look at, I see the AD line going straight up. Look at how many times Tesla finishes on the high of the day. This is unrelenting buying and demand on Tesla. You can say what you want about Tesla. Wall Street is in love with Tesla. Wall Street believes that Tesla is the new Apple. And you can buy into that or you can watch it. But we've had it in our portfolio now for the last 4 quarters. It's only been in one of our portfolios. Not like it's taking all of our portfolios higher, but I think the last 2 quarters it's been in the model, maybe 3 quarters. I think one of the quarters it was in maybe our strong AD or maybe it was in the aggressive. But anyway, Tesla's just been an animal. And so, but look at the relative strength. I mean, there's your autos. Here's Tesla relative to the autos. Outside of a little consolidation here, it's been almost straight up. So you got a leading, and here's autos relative to the S&P 500. I don't think there's been a better industry group. Well, I know there hasn't been a better industry group than automobiles in the last year. And Tesla is the leader in automobiles, probably along with NIO, which has also done really well. But that's why our portfolios have done well. We stick with strength. Wall Street tells us where we need to have our money. And I don't listen to folks, these headline articles at CNBC or wherever. I don't listen to the folks say the market's gone up too much. It can't go any higher. I believe we're in a secular bull market, and secular bull markets, whatever you think is as high as it can go, that usually dwarfs or pales in comparison to where it actually goes. Some of you might think I'm absolutely nuts, but I believe the S&P 500, which is at 3,800 right now, is going to be 10,000 or more by the end of this decade. So if you're looking at these stocks thinking that they're overpriced, overvalued, you're going to really think they're overvalued down the road. All right, that is it. I did skip over the earnings. KB Homes, one other thing I'll mention before we go. KB Homes reported their earnings last night, and the stock had a great report. And if I'm right about treasury yields in the short term topping and coming back down, we may see a little rotation back into the home construction group. And I'll pull that up, last chart here. And it is breaking back up above its moving averages here. That's what I would look for as one of the strong groups, maybe over the next few days, if the 10-year treasury yield continues to decline, because this is a group that's been held back a little bit by the rising 10-year treasury yield. I don't think that's justified. I think that this support will hold, and now we're starting to move back to the upside. I think home construction is an area you probably should be looking at right now as well. All right, that is it for me. Everybody have a great day. I'll be back tomorrow for my recorded version of Trading Places Live over at Stock Charts TV. That will air at 9 a.m. tomorrow morning. So you'll have to go over to Stock Charts TV to check that out. But I do want to thank everybody for being here. Good luck today trading, and sign up. Give us a shot at Earnings Beats if you haven't already. Happy trading, everybody.